The number of U.S. corporate defaults are already bigger than last year, and the Fed hikes by 25 basis points to 5.5%. That's the top of the range, highest since 2001. More rate hikes are on the table. QT continues. Most people just assumed the low interest rate environment was the new normal. It's going to happen forever. But in the wake of the COVID stimulus, price inflation finally caught up with those devils at the central banks, forcing them to raise interest rates. So, according to data from Moody Investment Services, 55 American-based companies defaulted on loans through the first half of 2023. Sounds like the commercial sector in real estate that I've been talking about for a year. That was a 53% increase over the total number of defaults in 2022. U.S. companies accounted for the majority of worldwide defaults through H1. Globally, 81 firms failed to pay loan obligations. Moody projects that the corporate defaults will continue to surge, with the default rate, coming in at 4.7% globally. In the worst case scenario, defaults could, looking at the micro data of this, rise as high as 13.7 to 14%. That, ladies and gentlemen, is surpassing the number of defaults in 2008. So a Deutsche Bank study projects defaults for U.S. high-yield debt will peak at around 9% in late 2024. The party's just started. So for comparison, the highest yield default rate was a mere 0.5% in 2021 and roughly 1.3% in 2022. So the Fed, started, in determining the extent of additional policy, firming that may be appropriate to return inflation to 2% over time, as it was in the previous administration. Good luck with that. The Fed's FOMC raised its 5 policy rates by 25 basis points today, which pushed the upper limit of its policy rates to 5.5%, the highest since January 2001. The Fed had broadly telegraphed this move after the very hawkish skip meeting in June. I did a talk on that when it projected 2 more rate hikes this year. The Fed has hiked by 525 basis points in 16 months, the fastest rate hike cycle since 1980, to deal with the worst inflation in 41 years. Part of this, ladies and gentlemen, when the new administration got in office, they shut off our energy. We were energy independent. Had nothing to do with COVID or the Russia war. So that vote was unanimous, and the Fed also put another rate hike on the table for this year. It's just getting started. So kind of look at the summary of this, what this meeting happened. The federal funds rate target to a range between 5.25 and 5.5%. The interest it pays on the banks on reserves to 5.4%. Interest it charges on overnight repos to 5.5%. Interest it pays on overnight reverse repos, this is important, the RRPs, to 5.3%. And primary credit rate to 5.5%. That's what the banks pay to borrow at the discount window. So amend all this hype and, interest rate cuts that have been, bubbling roughly for over a year, in my opinion. We note that, the plateaus after a series of rate hikes, kind of are the rule right now. What's causing the rise in corporate defaults, ladies and gentlemen, we all know. Rising interest rates coupled with tightening on lending. So over the last 15 years, corporations could generally get financing roughly between 4 to 6%. The interest has now surged between 9 and 13%. So what is going on? It's quite easy to figure this out. The central banks are popping bubbles. Central banks incentivized a borrowing spree with more than a decade of artificially low interest rates. But when price inflation caught up with the monetary inflation, what happened? Central banks were forced to hike rates. Now we have an environment, rising interest rates are popping bubbles, blowing up by the loose monetary policy, period. And, central banks push rates to zero in the wake of the Great Recession. We all remember. My opinion, I've always said rates should never be below 10%, but we have 50% of Americans only have $500 in their account, this fake economy. And some banks, including the European Central Bank and the Bank of Japan, I did some talks on this, they took rates to negative, if you remember. Despite some efforts by the Federal Reserve to normalize rates, if you remember this in the late 2010s, they didn't do that for long. It never succeeded and had already started cutting rates due to the shakiness in the economy. They got a lot of phone calls on that, said go back, keep them low. And that was before COVID. So during the pandemic, central banks, they doubled down on their easy money policies. So kind of summarizing, if you look, this is pretty astonishing when I was looking at some of this micro data. The global debt hit a record 300 trillion at the end of 2022. That's according to the data from the S&P Global. That equals 349% leverage against global GDP and 37,500 of average debt for each person in the world. Since 2000, non-financial corporate debt across America and Europe has grown from roughly 12.7 trillion to an astonishing 38.1 trillion. That's a 201% increase, ladies and gentlemen. So what have these folks been doing? What is the low interest rate? Low interest rates. Low interest rates are the mother's milk of a global economy built on easy money and debt, period. With interest rates rising, the bubbles are starting to pop. That's how vulnerable this economy is. Rates just went up 1%. Remember when it just started? See how many people had some problems? What nobody seems willing to say out loud is that the problem falls squarely on the shoulders of governments and the central bankers. They implemented policies intended to incentivize the accumulation of debt. They created trillions of dollars out of thin air and showered the world with stimulus, unleashing the inflation monster. And like I said, the current administration in the United States cut down our energy day one in office and signed executive orders. That doesn't help. And now they're trying to battle the dragon they set loose by raising interest rates. Good luck. This will inevitably pop the bubble they, intentionally blew up. So if you follow the central banks and what they have been doing since the 1930s, this was all predictable. It's absolutely, ladies and gentlemen, 100% shameful.